Hi, everyone. Welcome back to Interactive Brokers Podcast. I'm Jeff Praisman. It's my pleasure to welcome back Will Rhind, founder and CEO of GraniteShares. Hey, Will, how are you?
Good, thanks, Jeff.
Always love having you come in for our monthly talk. And for our listeners, Will is a longtime commodities expert. And today we're going to explore, how investors can think about commodities and portfolios, how politics is shaping markets, oil markets right now, and also like how investors can navigate this volatility with a little bit more disciplined, data-driven approach. So, Will, I want to kind of kick it off with the big picture. Why should investors consider a commodity allocation alongside traditional stocks and bond portfolios?
Well, historically, commodities have acted as a diversifier to traditional stocks and bonds. If you think of the two major asset classes being stocks and bonds, and commodities arguably is the third in terms of importance. And so typically you have portfolios that are constructed with stocks and bonds, and then people that are looking to add more diversification use commodities. And they function as a diversifier because it's a different return stream. What drives the price of oil is very different from what drives the price of Nvidia or Amazon, and also what drives bond prices. So they act as a diversifier. They also act as a hedge against inflation. Why is that? Because commodity prices themselves can be a very specific root cause of inflation. Clearly, if the price of oil is rising or other commodity prices are rising. So that is typically really the two big reasons that people include commodities in a portfolio.
And why do they provide? Is it just because they just react differently to market? Like that's how they provide the diversification benefits? Especially, it seems like a periods during market stress, people kind of tend to flock toward them.
Yeah, I think that people are always interested from a diversification perspective. It's about the optimal return per unit of risk. And so when you add, assets that are not correlated together, you lower the risk of the overall portfolio. And so that's what attracts people to commodities. And the reason why that they are less correlated with traditional stocks and bonds is because the drivers behind commodity prices are just different. And so they are additive to a portfolio, and therefore, they operate in different ways. And certain commodities, such as oil, as we're seeing right now, can spike very violently when there are particular crisis events at the moment. And that can add value, especially when people are looking to hedge energy prices within a portfolio.
Yeah, and I think it's almost for probably some of our listeners, it almost seems a little counterintuitive though with the inflation, right? Because people just associate inflation, everything's going up, right? They don't necessarily kind of focus on different items. They just say the bread's going up, their gas is going up, whatever. But how is that relationship different than them between the prices, commodity prices and inflations? And when do they actually, I guess, kind of a high level view of the mechanics of how they function as that effective hedge?
Yeah, I mean, I think first and foremost, inflation is normally viewed for right reasons as a negative. So like you just said, cost of bread's going up, the cost of gas is going up. That means people are paying more for goods, services. So that's typically a negative because it's costing you more. But if you put it in a portfolio context and say, okay, I realize that this is a thing. How do I profit from this? Or how do I make money from this? Then you want to be owning assets that benefit, i.e. rise with inflation. And so commodities, because, for example, energy prices, let's just take that, energy prices run through everything in the economy. And so if energy prices are rising, guess what? That feeds through into goods and services. And so if you want to try and hedge a portfolio, meaning that you make money from inflation rises, then commodities is one way to do that.
And when people think about commodities, you and I have talked about before, gold probably is the first one to come up. But how important is for investors to look beyond gold and understand that there's a broader commodity universe out there? There's energy, there's metals, there's agriculture. Culture.
I think that there's a great example where gold has historically functioned as an inflation hedge. And a lot of people do think of commodities being synonymous with just gold. It's very something that everybody in the world knows what gold is. They have a view about it. But at the same time, you have to also be aware that commodity markets are more than just gold. And I think for a lot of people, energy is the most important commodity complex. And so being able to add exposure to energy in the portfolio is really key, especially if you're looking to correlate with inflation or particularly take advantage of inflation, because energy is actually the most positively correlated with traditional inflation measures. So if that's your goal, to try and hedge a portfolio against inflation, and certainly broader commodities, including energy, would be a place to look.
Yeah, and
And
commodity markets can be volatile and somewhat often headline driven. How should investors think about participating in that volatility without just simply reacting to the short-term news? Like obviously the Iran conflict's in everyone's mind right now and all over the headlines.
yeah, I mean, I think that there are obviously a number of ways to do it, but I think the most sensible approach is to think about it as a broad allocation in a portfolio. So in much the same way as an investor would buy exposure to the S&P 500 or to a large bond index through an ETF, you could do the same thing with commodities. And in that way, you don't have to worry about whether oil's going to outperform natural gas or whether corn's going to outperform wheat. You just hold them all in a basket or in a portfolio. And that way you can add a percentage to your portfolio and still benefit from an allocation
Mhm.
to commodities, but without making that sort of micro decision about which commodity specifically to back.
Yeah, so it sounds like investors really have the choice whether they want to target their exposure to a specific commodity, have, a broad basket of commodities and, in equity terms like an index basically. And it seems like there's probably a need for both, depending on the investor and the user.
Yeah,
Um,
that's right. And of course, investors have different needs. And
mhm.
the great thing about the ETF market today is you'll find ETFs on almost everything. So if you have a very strong view on oil, there are ETFs that cater to that. If you have a very strong view on some of the metals or agricultural commodities, there are ETFs there. But also if you don't, and again, you're agnostic per se to individual commodities that don't want to get that granular and just want the one ticker solution, then there are plenty of ETFs for that.
And you mentioned oil, and obviously that's in the news right now. It's with everything going on. I'd like to kind of just focus on oil for a second. How are the current oil prices? How are they balancing the expectations for the global demand against the rising geopolitical supply risks that we're seeing?
So at the moment, clearly, it's a very volatile period in the oil market. We've seen oil at over $100 a barrel, slightly less than that today, given obviously the market's expectations of hopefully there'll be some kind of resolution to the Iran war. But, there's been big volatility around almost on, a daily basis regarding the global supply of oil, particularly coming out of the Middle East. And, therefore its knock-on effects to the global economy. We've seen gas prices rise, obviously here in the United States, but particularly in countries where, they're not completely energy independent, such as Europe, Asian countries as well. So this is one of the most extreme expressions of when you see distress in commodity markets. And we're seeing right now the impact that oil has on the global economy and how that rise is felt by almost everybody everywhere.
And for investors and traders, I mean, there's a lot of noise out there, right? And kind of distinguishing the signals from the noise is pretty important. How do they separate the short-term geopolitical headlines versus the actual disruption that oil production or transportation actually could occur or is occurring?
That's a very interesting question. I think that it is tempting to get swept up in the headline volatility that we see on almost a daily basis. But I think that if you can look beyond that, number one, having a long-term allocation to something like commodities is probably always, something to consider as opposed to trying to react to short-term events.
Mhm.
But perhaps a good example is something like Russia Ukraine, where that was incredibly disruptive after Russia first invaded Ukraine. But as you can see, the longer that goes on, the more that sort of gets priced in to markets and ultimately markets move beyond that conflict and focus on other things. And I think the market's desperately trying to move on right now from the Iran war. And, I think you can see that in the pricing, terms of equities hitting new all-time highs, oil coming up. But of course, that situation can change, particularly if the Strait of Hormuz, for one, gets disrupted in a major way again. All of that could turn on its head quite quickly.
And is OPEC playing any kind of role in stabilizing the oil markets or amplifying? Are they sort of just kind of on the sideline with this right now?
Well, it's interesting because on the one hand, OPEC's role, you can argue, is to act more like a stabilizer,
Mhm.
in normal market times. And so they're able to either increase supply at the marginal level or decrease supply, according to their view on oil prices. But of course, this situation is unique because it captures a lot of the major OPEC producing countries right in the middle of this storm. And so for anyone from the Saudis to other countries, oil producing countries in the Middle East, I mean, clearly their production is directly affected by what's going on and the ability to take their, oil product and ship it globally. So, perhaps in normal times, yes, that they would be able to act as a stabilizer. But as of right now, they're being directly affected by this. And therefore, the ability to stabilize crude production and ship and move crude around the world is really key at this stage, I think, to stability.
And oil obviously comes from a lot of places in the world that tend to pop up when we talk about sanctions, right? Russia, Iran, Venezuela. How effective or significant are these sanctions and the risks they come in, and actually the enforcement of them when it comes to supplies from these countries, or are they sort of can kind of get lifted when they need to be?
It's tough. I mean, I don't want to say that they're not effective because I
Mhm.
think that's clearly false. I think they're just they're never going to be as precise a mechanism as perhaps they're intended to. So, for example, take Russia. Although right now those sanctions have been temporarily lifted due to the global oil price, Russia's been heavily sanctioned in terms of their crude exports. And those Western sanctions cover about 70% crude exports from Russia. However, their exports remain resilient because they have other buyers that are not subject or don't or ignore, I should say, sanctions, such as China. So this has been the same thing that has gone on with Iran and the Iranian economy for the longest period of time. That the economy's been under sanctions, but they still find ways to sell to people who either are outside of sanctions or ignore sanctions completely. And so again, they are effective, but I don't think they can ever be perfect. And that's really the
Mm.
problem.
And I kind of want to take a step back now and kind of focus more on just different investment products, right? So, and also just signals as well. So, like, obviously inventories matter, but then, people may not realize like there's, futures on these commodities. So, like, there's future curves that come into play. There's option markets. There's ETFs. How can they all be used basically to reveal how these geopolitical risks are being priced in? Like, do they all kind of coordinate with each other? Are there different things to look for with the different data?
Yes, no, I mean, absolutely, because they are all keyed off of the actual markets themselves, whether it's completely directly in the case of if you own physical gold, for
Mm.
example, or whether it's again directly through a futures contract that's linked to oil deliveries at a certain point in time, that they're all ultimately linked directly and indirectly to that underlying commodity price. And therefore, they are the transmission mechanisms for price discovery in the market and therefore correlate exactly with what's going on. I think where perhaps some confusion can happen is that oil does have a cost to ship and store around the world. And that's reflected in the futures curve of oil, which is the price of oil to be delivered today at the front of the curve, and then the price of oil to be delivered in the future, which is further out the curve. And sometimes you can have a situation where the front of the curve trades higher than the back of the curve, and then vice versa. And those situations will dictate whether there's more urgency to deliver a barrel of oil today, or whether you deliver a barrel of oil in the future. So at the moment, we call that curve backwardated if the price is higher today than it is going forward. And the opposite situation we call contango, where the price for delivery today is lower than the price for delivery in future.
And there's often been an assumption that U.S. shale can act as a shock absorber in these situations. How responsive is U.S. shale to this geopolitical supply disruptions? And where are the limits to that response? Where do they show up?
So shale definitely is a response mechanism. I think that shale correlates again largely to the global price of oil, and as we've seen in the past, that a lot of shale production was bought on when capital discipline was perhaps not as strong as it is today, and of course, where interest rates weren't as high as they are today, and the net result of all of that was that the industry bought on too much production that was overfinanced and ended up being a big bust for shale. We're now at the other side of that, but it's still strongly correlated, I think, to the price of oil and to the ability for companies to finance and their capital discipline within the market. So certainly with prices, as high as they are now, will encourage more production, and production is certainly meaningful. So I think shale or crude production at least is about 13 and a half, 14 million barrels this year. And shale plays a big part of that. But it's something, again, that is driven largely by the price of oil, because companies have to be profitable and their ability to have sustainable financing to access that.
And, final question, Will, and in this day and age, there are so many tools for investors to get exposure to, commodities and energies, like not just the futures, obviously, but, there's energy ETFs or, commodity ETFs. There's options, there's spread strategies. How can investors use these tools to kind of manage this oil-driven volatility more effectively?
Yeah, I mean, the great news is that there's now a huge array of choices, and really you can almost buy an ETF for everything. I think in terms of oil shocks themselves, you have the ability to participate in that directly by buying ETFs that just have underlying oil futures exposure. You can buy a broad commodity ETF that invests in the underlying commodity futures, a big portfolio like a S&P 500 type approach. Or you can buy exposure to stocks that are involved in oil production or oil services. So there are a number of ways to do it, and again, every expression of that has its sort of pros and cons. And ultimately it's about what do investors feel most comfortable with, what aligns with their investment goals or not. But certainly the tools are out there for people to take advantage of.
Will, this has been great for our listeners. You can find more from Will at GraniteShares.com. He comes in once a month to our studio for a great podcast on commodities. And my takeaway is that, commodities, and especially oil right now, they really reflect real world forces like geopoliticals, inflation, and, supply constraints. But there's also a lot out there for the investors to get either broad exposure or targeted strategies that just understanding how these markets function is really essential for them.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at ibkr.com. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Investments in certain commodities, precious metals, may be subject to significant price volatility and often involve risks related to market fluctuations, liquidity constraints, geopolitical events, and changes in global economic conditions that could adversely affect their value.